morning, I'm Daniel Sinacero, CEO of Connect Media and Connect Commercial Real Estate News. Thank you for joining me on this special coverage here. There's a lot going on here in the market, and so we thought it would be a good idea for us to get together and talk about it. Every second matters. Every piece of information is so vital to our industry. I get the fortunate part of getting a lot of this high-level information and a lot of really big thinkers in the industry. Marcus and Millichap has done over 9,000 transactions last year in all the different property sectors, and I'm joined by the CEO of Marcus and Millichap, Hessam Nadji. Thank you for joining me, Hessam.
Daniel, thanks for having me on the program.
So, crazy end of a week last week, crazy start to a week this week. You and I jumped on the phone and we thought, let's inform the industry. So let's jump right into it and ask some of the big questions. You know, I've seen all of us on panels and we always talk about what could slow down the industry, what could slow down the market. And we always say there's some black swan event. Is the coronavirus the black swan event we've been talking about?
Maybe it is. Based on what we've seen so far, in my opinion, that's yet to be determined because the facts are still unfolding. We don't really know the scope of the problem, and most of the media outlets are reacting to the worst case scenario, as is the stock market. So it's a fear-based reaction without valid information. Natural reaction, we've seen it before, but it's really important to decipher all the emotional component of what's happening from underlying data.
And like we talked about this week, you know, all the pharmaceuticals are going to inform the president tomorrow. Stock market took a big jump today, so that was great. But the 10-year Treasury went down. Tell me about that.
Well, it's fascinating to see the stock market as the most common barometer by everyone in terms of you know, the representation of what is happening in the world. And I think that's overplayed because of the fact that the stock market in and of itself appeared to be overstretched to some extent going into the new year. We'd actually raised that flag. And if you look at earnings versus the PE ratio of the S&P 500, it was clear that there was some overvaluation going on. So there is an exaggerated reaction to the most common barometer, and therefore it's sending, in my opinion, a false signal of the reality on the ground. You contrast that with commercial real estate, you contrast that with the actual economic data, and the two don't quite line up.
So let's talk about values. People don't want to overpay for an asset. And they say, you know, pricing's at an all-time high right now. Stock market is dropping, it's volatile. Is there still some money to be made in commercial real estate?
Absolutely, there's value everywhere. But you can't paint the market with that general brush. To your point earlier, the fear factor has moved the 10-year Treasury yield to an all-time low. Today, the stock market rebounded, as you mentioned, but the 10-year stayed pretty much where it was at. That still indicates a fear factor in the marketplace. That fear factor, even though it's exaggerated, is creating a window of opportunity where looking at the long-term benefits of commercial investments, commercial real estate investments, I should say, especially in contrast to the S&P 500. If you look at the long-term, real estate has outpaced the stock market for sure. That is now further supported by this incredible window of being able to lock in low interest rates as a shield against future risk, as a shield against what may or may not go wrong in the future. We're in our 11th year of an expansion. We don't have an inflation problem. We don't have an overbuilding problem. We don't have an over-leveraging problem, much like every cycle that I've lived through since my 30-plus year career in commercial real estate. So bringing it back to your question of whether real estate is overvalued or not, I would say in general, no, based on those facts, based on the fact that the economy is sustainable. If you're adding jobs, frankly, even at a much less of a pace than we have been recently because of coronavirus or other factors that may come up, the lack of overbuilding gives us a lot of cushion to absorb an economic shock, unlike any other, you know, late stage of an expansion that I've certainly seen.
So expansion, we talked about the stock market, we talk about the coronavirus, we talk about these events that are slowing down the market, but we also have an election. Super Tuesday is tomorrow. We're in California. Do you feel the burn? No, do we? I mean, just talking about politics as a whole, do you think it's the coronavirus, or do you think it's politics, or is there any other source of slowdown that are affecting the waves?
Well, clearly in the last 10 days it's been coronavirus, but we're in a situation where you have 1,000 paper cuts, potentially becoming a headwind, potentially becoming a factor that creates more fear than the reality on the ground. And we've been here before. We've been through cycles like this before. There was a lot of uncertainty in 2017 regarding the Tax Reform Act. There was a lot of uncertainty regarding what would happen after Donald Trump won the election, which was an unexpected outcome, and interest rates spiked 70, 80 basis points in just 3 weeks. The market has absorbed these windows of turbulence, and the uncertainty of the moment will become more certain as we move down the road, I think, over the next several months. But the long and short of it is, are we creating jobs? Can job growth be at a much lower pace and still create demand for commercial real estate? Have we overbuilt the asset class? And the answer to all those is yes and no. The demand should be sustainable, and the oversupply is not in the scene. Those are the facts I keep looking at. And those are the facts that have kept us fairly accurate in being able to share perspective with our clients and investors over the past really 7 or 8 years that for the most part have been pretty accurate by getting away from the emotion and looking at the facts.
So let's stick on the client. What are your clients asking you? I mean, I'm sure the phones are ringing, and what are they asking?
Most of our clients are interpreting this as an opportunity. Most of them that were somewhat hesitant are now really aggressive about making a decision on a refinance, on a trade, a 1031 exchange, on an outright sale, or an outright acquisition. Today's acquisition opportunities with interest rates at the levels that they are significantly more attractive than they were just a short while ago. We are remarketing all of our inventory to make sure that every potential buyer out there is aware of what we have listed. We have one of the largest inventories of commercial real estate assets in the marketplace, and deliverable with reliability. So that has a lot of value to buyers that are now better positioned because of low interest rates to execute transactions. Most of our clients want deal flow. They want to know the current opportunities. And we've built all kinds of infrastructure and a real commitment to making sure that our clients are always aware of the opportunities that fit their mold and their buying requirements. So the phone has been ringing. There's been a lot of concern about a recession. There's been a lot of concern about the effect of coronavirus already on fewer business trips planned for various groups and conferences, less consumer travel, and the supply chain disruption, all of which I think to some degree will slow down growth this year. But I don't believe we've seen enough to say that we're going to head into a recession. The risk of a recession have risen, but not to the point where I think we are going to be in one this year. And depending on how quickly this is resolved, hopefully it's as fast as humanly possible, really for the human component of this and the public health component of this, which is far more important than anything else. A lot of people are suffering. Let's not lose perspective on that. And assuming that in the short to midterm there is containment and resolution of some kind, I think we're going to see a bit of a slowdown and a pickup on the other end of it. Because remember, the demand side of the equation, economic and real estate demand side of the equation, was doing very, very well. And so after a disruption, there should be a bounce back.
You bring up something interesting. You talk about interest rates and demand. So interest rates, okay, let's talk about what the Fed, everybody's calling for the Fed to do something as they come in. They're talking about half a basis point, full basis point. What do you think the Fed should do? Should they lower interest rates? Should they jump in and help with the stimulus?
Even before suggesting or for them to try and determine specific action, coming up with a communicated plan, coming up with a communicated sort of framework by which they're going to step in and support the economy if necessary, whether it's through rate reductions. But rate reductions alone is not enough. And there has to be other mechanisms for increasing liquidity, and may take some creativity. Every cycle is a little bit different, and we've seen the Fed become more effective and more creative over the past 10 years. So it's not even so much we should decrease interest rates at a certain level right now or not. It's more of a communication of a path to which they would stand by the economy. I do think the chances of a rate reduction are significantly higher. But again, we have to see the data coming in. Last week could have been a gross overreaction to what's happened around the world. Because over a 1 week period, the fundamentals themselves didn't change that much. We could be talking ourselves into a much bigger problem than is actually occurring.
Well, you talk about the interest rate part. We talk about the interest rate. People just mentioned some of the EU and some of the people jumping in and saying they would help if this got worse. People got confident. It raised 1,300, right? Just 12 to 1,300. I mean,
that's an absolute relief rally
Yeah.
that came to fruition today and could have a follow-on. But then again, some other news could erupt in the next few days. It's a fragile situation. I don't think anybody should really try and determine a strategy based on last week or this week. Real estate is a long-term asset with the tax advantages, with this unique 11-year expansion that still has legs, separate from the events related to the coronavirus. And this very unique time where we're not overbuilding, over-leveraging. The two most common implosions that have brought cycles to an end within commercial real estate are absent. And I think that's more important than any of the short-term, week-by-week gyrations.
Well, Hessam, this has been wonderful. Thank you so much for taking the time, and thank you for inviting me into your offices here in Calabasas. And I look forward to doing this again.
Daniel, it's my pleasure. Thanks for talking to me.